Starting now.
Good afternoon, everybody. I can see people starting to join our room. We're just going to wait a minute to get more of you inside. I see everybody coming in and now, and then we'll make a start. Hope everyone's enjoying the afternoon. Some of you may be experiencing rain, other sunshine. I think we have all types of weather this afternoon here on the island. From my window, I see cloud. Okay, I think many of you are with us, so we're going to make a start with our afternoon. Very warm afternoon and welcome to everybody. Welcome back to many of you, as I've seen some very familiar names. Some of you that maybe have joined our other webinars. It's a great pleasure to have everybody with us today. For this, our last in the current series of our webinars, but please watch this space because there will be more coming. We thank you also for some of your requests. We've been listening to you and we hope over the following months to be able to offer you a few more of our free webinars. As most of you already know, my name is Sophie Giriago and we also have with us today Joanna Vrioni. And we're part of the team here at the European Institute of Management and Finance, or EIMF, I guess, as most commonly people call us. For those of you that perhaps are joining for the first time, just to indicate that the EIMF is a leading European training provider, offering training and professional qualifications across an array of different learning areas and across all sectors. Although we do have quite a strong presence and specialization in the field of finance, accounting, corporate services. Our learning areas, though, include personal development, the soft skills, management, technical, accounting, financial regulation, banking, legal, just to mention our key areas of our expertise. Our learning initiatives are offered via live online, e-learning, and we hope very soon to be able to also return to our classrooms. Those of you that do know us well, of course, we already know our team here at the EIMF, and you will for sure know that we're a group of people who share a passion for learning, I guess. Ongoing learning, we enjoy watching professionals become better at what they do. We offer advice to you as professionals, to you as university graduates, and even school leavers that contact us to get some advice or to a direction of their future careers. So for any newcomers, we hope that now you'll also feel free to join us and to get in touch with us. So, what are we here to do today? Those of you obviously that have been watching our series of webinars will know that we chose different topics across an array of things. We looked at our emotions, we looked at legal tech, we looked at sales. And today we've chosen one of the newer international financial reporting standards. And we've chosen one that we believe professionals in Cyprus currently have a particular interest for. So we'll be addressing the IFRS 16, which is going to be looking at, of course, leasing and what's new for the leasing agreements. But before we move on to introduce our presenter, who's going to offer us his insight in this topic, just to quickly mention that we will be taking questions and answers and we encourage you to write your questions in the question and answer section at the bottom of your screens, and we will revert to them at the end of the presentation. So let me say a little bit now about our presenter. Our presenter today actually is our very own EIMF trainer and tutor, Marios Mortis. I say tutor, just to not know if anyone's confused. I say tutor as well because he actually also teaches accounting qualifications, and he actually is our tutor for our AAT accounting qualification that we currently run. And we're hoping by the end of the year to also have one of our newer qualifications, which is actually the Chartered Institute of Management of Accountants, that Marios will also be our tutor for. A little bit of background about Marios. He holds a bachelor's degree in business administration and accounting, a master's in banking and finance. He's a qualified ACCA holder and has quite vast working experience in accounting, audit, advisory, assurance, banking, and has held different positions within companies in Cyprus. However, in the last 4 years, Marios has continued his career in the education field, where he is able to deliver training for professionals, as well as continue with his training in qualifications. Marios develops professional training courses on different topics across the area. Such as corporate reporting, accounting, finance, financial workshops specific for industries, just to mention just a few of those. Here at EIMF, his position is trainer and accounting programs leader, where he does all our specialized topics, as I mentioned previously. And some other areas, of course, will include things like cash and treasury management, credit management, ethics, risk management, and more. So as an auditor himself and with his experience in IFRS, we hope that he will be able to share insight on today's IFRS topic. So I think without any further ado, I'm going to hand you over to Marios to make a start. So let's hear what he has to share with us today. Marios.
Thank you, Sophie. Hello, guys. I would like to welcome you to this hour session today. It's my pleasure having all of you here today with me. Today we are going to discuss a very interesting topic that has to do with the leases. And we'll talk about the new IFRS 16, the new standard that provide guidance about the accounting treatment of leases. This standard came in to replace the previous standard, the EIS 17, who previously guided us about the accounting treatment of leases. And this new standard comes in to correct some inconsistencies the previous standards had. Let's see, before start talking about leases, let's see what we will try to achieve today. Today we will try to learn how to distinguish between the lease and the service contract. This is the first step of the process. When we treat accounting-wise a lease agreement, we need to identify the components of a lease that has to do actually with a lease, and what are the components that are services which the two requires different accounting treatment. The second thing to achieve today is to identify a lease agreement. We will follow 4 basic steps, answer 4 basic questions in order to identify a lease agreement, and then apply the requirements of the new standards. Then we'll learn to how to calculate the lease liability and the right of use asset as per the provision of the IFRS 16, which is the new thing that it was introduced with the new standard, the IFRS 16. And then how to apply the requirements reporting-wise of IFRS 16. The agenda for today is divided into 4 parts. The first part, we will discuss the importance of the new standard and how the introduction of this new standard will impact the companies. Then the second section will talk about the non-current asset and how to identify a lease agreement, the steps that must be followed. And during the third section, we will discuss about the recognition and measurement of the lease and how we present those items to the financial statements. And then we close this session by mentioning the most important areas we need to have in mind when we treat a lease agreement. Let's start with the first section. A company can acquire the control, obtain the right to use an asset in two main ways. The first way is to buy an asset, to purchase an asset. Under this option, a company will own the asset. And having said that, we can say that the company has a full control over how to use this asset and for the duration of this usage of this asset. And is exposed to all the risk and rewards, can generate income by using the asset, and etc. For the accounting treatment for this option, we have the IAS 16, the property plant equipment, which says mainly, especially said that to identify, to report an item as an asset of the company, there are three requirements. The company control the asset or own the asset. So if I purchase an asset, I legally own the asset and control the asset. To be able to identify its value with a reliable measure. The second criterion, the purchase price is easily identified and reported on the balance sheet. And to be able to obtain future economic benefits from the asset, either by using the asset and generating additional income, or in a cost-saving way of economic benefits, of acquiring economic benefits from saving a cost for the company. It's important to mention the definition provided by the property plant equipment, the IAS 16, because it must be read in conjunction with the new IFRS standards, which applies to the second option and applies to the new IFRS 16. We have the lease, the second option, to lease the asset. If an entity leases an asset, it's paying another entity, which is the owner of the asset, for the right to use that asset for a predetermined period of time. So the ownership of the asset is at the hands of another entity, paying this another entity to use the asset and generate some income for myself for a specific period of time. The owner to this agreement is the lessor, the owner of the property, and the entity that is actually using the asset is the lessee. This option, the accounting treatment of this option is guided by the new accounting standard, the IFRS 16. The leasing industry nowadays, the last couple of decades, was expanded significantly, and the International Accounting Standard Board identified this expansion and identified a very specific inconsistency in the accounting treatment of the leases. The inconsistency is that if I'm leasing an asset, I am satisfying all the requirements that the property plant equipment standard, the IAS 16, defines to be an asset. So if I'm leasing an asset, I'm controlling the asset, I am getting the economic benefits from using this asset, and this usage has a value. So with the new standard, the standard setting board comes in and said, okay, you are using the asset, you generate some income, you need to report this to your balance sheet and inform the users of the financial statements about the exact values of these transactions. Something that previously we just report a rental expense and lease expense on the profit and loss. And the users of the financial statements have no idea about the exact values of these transactions. We said before that the leasing industry was expanded the last couple of decades. Here I have some numbers that indicate this. This industry was expanded, especially in North America and Europe. 62% of the listed companies operating in North America are using this method of obtaining the control of the asset. Some say 47% of the European countries are using this method as well. If we sum all these transactions to a number, we can see that the value of these transactions exceeds the $2 trillion worldwide. And having said that, we can understand the impact of these transactions, and this value is not reported on the financial statements of these companies. If we take a closer look about the leasing industry, we can see that some sectors are overusing this option, the leasing option, especially the retailers and the airline companies and the travel and leisure companies are using this method of obtaining the control of the asset, using this asset to generate some income. Now, what changed with the new standard? Previously, we had the ES 17. The ES 17 said us that we need to distinguish between two kinds of leases. We have the finance lease. To identify the finance lease, we must look at some specific characteristics, and the operating lease, which poses different characteristics from finance lease. Many companies, the majority of the companies report their leasing activities using the operating lease option, which means that nothing of the value of the asset used to generate income were reported on the balance sheet. Now, with the IFRS 16, the introduction of the IFRS 16, which, by the way, is enforceable from January 2019 onwards, this change, and the standard setting board comes in and said, you using the asset, you need to report this asset on your balance sheet. So all the leasing activities now are reported on the balance sheet by recognizing a value of use of the asset as an asset and the lease payment due under the lease contract as a lease liability. We will explain later on how to calculate these two items. So with this way, the users of the financial statement will be aware of the leasing activities of their companies, of the company under consideration. And having said that, we can understand that, as we will see later on, that some metrics of the balance sheet will be impacted as well. Now, for the profit and loss, using the ES 17, the previous standard, we just recognize a single line expense, this of leasing expense, on the P&L and nothing more. Now, the new standard said that you have to split this expense previously recognized as a line item into two components. The interest part, because when we talk about the lease, we talk about financing activities, because we acquire we obtain the control of the asset, and we are obliged to pay some money in return. So this is a financing activity and carries an interest. So you need to recognize a component of interest that is embedded on this agreement, and depreciation amount, which is mainly calculated over the lease term. And again, having said this new addition, we can understand that against some metrics like EBITDA, the earnings before interest, tax, depreciation, and amortization will be increased, and the operating profits will increase as well, because operating profits are calculated before the deduction of finance cost, because part of this expense will be classified after the calculation of operating profits. We will see the impact, the potential impact on some metrics. We have the P&L metrics, margins to ratios, and how the new standard, the IFRS 16 new accounting will affect them. The EBITDA, the earnings before interest and tax, depreciation, amortization is expected to be increased. The operating profits will be enhanced as well. The net income, it depends on the transaction. On the other hand, the return on assets and the asset turnover will be lower because of all these reclassifications. The balance sheet metrics, we expect the debt to equity ratios to be increased because now we are recognizing the liability, increasing the liability part of the balance sheet. And the interest coverage ratio will be reduced as well because on the P&L, we need to recognize an interest that is derived from our leasing activities. And the cash flow metrics, our cash flow from operating activities, because we deduct the rental expense or the lease expense, will be enhanced, and the cash flow financing activities will be reduced because the financing component will be classified under the financing activities. But at the end result, the net cash flows will remain unchanged. Now, what are the intended benefits from the introduction of the new profits? First of all, we remove any inconsistencies previously had about the accounting treatment of leasing. We need to recognize assets and liabilities for all leases now, not just for finance leases previously done. We need to measure all the lease assets and liabilities in the same way. The requirements of these standards are applied to all leases. And we need to recognize only the rights that are obtained and the liabilities incurred due to the acquisition of these rights. We'll explain later on how to calculate these rights. And the company's management operating decision will be reflected in the financial statement because the management decides of how to finance the acquisition of an asset that will be used in the business, either acquiring an asset or leasing an asset. Before start talking about how to identify a lease agreement, it's important to understand the rationale behind the introduction of the new standards. Previously, for all leases, for the majority of leases, we just report a line item, a line expense, piece of lease expense, and nothing more. And the users of the financial statements have no idea about these types of activities by the companies. And the standard setting board designed this, introduced this new standard because there was an inconsistency. The leased assets are assets used by the business and must be reported on the balance sheet as they tick all the requirements the IFRS 16 standard determines. Now, how to identify a lease? The definition of the lease agreement remains relatively unchanged as compared to the IFRS 17 definition. A contract or a part of a contract that conveys the right to use an identified asset, which is the underlying asset, the asset that is included in the agreement, for a period of time in exchange for consideration. All these elements are important to identify, are important, and we need to consider them separately in order to identify when we talk about the lease agreement or not. As we said, we need to answer 4 questions. The accountants are used to make some questions to themselves, and when they are trying to record a specific transaction. The first question to ask ourselves is there an identified asset? So this question try to determine if the lessee can use the leased asset separately from the other asset the lessor owns. The first indication for this, can the asset be used separately from lessor's other assets? An identified asset can be physically distinct portion of a larger asset, like a floor in a building, or is an individual separate asset. This asset can be identified either explicitly in the lease agreement, if we talk about leasing a car, with the registration number of this car, or implicitly, which means that the asset is not mentioned in the contract, but the supplier can fulfill the contract only by the use of a particular asset. For example, there is a very specialized asset, a medical equipment, for example, that no one else except of lessee can use this asset. There is no reason to clearly mention this asset to the lease agreement. The second indication about the identified asset is the lessor has substantive right to substitute the leased asset. This is an important indication we need to look at. If the supplier has substantive legal right to substitute the asset throughout the period, at any point in time at the lease period, during the lease period, the entity does not have the exclusive right to control this specific asset. Like, for example, I am leasing a copy machine and the lessor has the right to come in my building and replace the copying machine with any other machine. If this exists, then we don't have an identified asset and we don't have a lease agreement. But we need to be careful about defining the substitution right. The substitution of the asset for repairs or maintenance of the leased asset, it does not preclude the asset from being an identified asset. So if the lessor has the right just to substitute the leased asset only for repairs, then we have an identified asset, we have a lease agreement. The second question to ask ourselves, customer has right to substantially all the economic benefits, the lessee has right to all the economic benefits. And this can be achieved through holding, using, or subleasing, if such provision, including the lease agreement, the specific asset. Is the lessee able to derive economic benefits from using the leased asset or not? This assessment must be made only within the parameters of the contract, meaning, for example, to use the asset only in Cyprus and not abroad. The third question has to do with the usage of the asset. Who directs how and for what purpose the asset is used? The right to control the use of the underlying asset depends on the lessee having both the right to obtain substantially all of the economic benefits from using the asset and the right to direct the use of the identified assets. So the lessee has the decision of how and for what purpose is going to use this leased asset. If not, if the answer to this question is the lessor has a word of how to use the asset, then we are not talking about a lease agreement. And what is the duration of the agreement? The last question to be asked. The duration is important. It is important because there is an exception available, which we discuss at the next slides. What is the duration of the agreement? The lease term is the non-cancelable period of a lease together with any options to extend or terminate the lease, given that these two options are assessed and is reasonably certain that are going to be exercised by the lessee or any of the two parties in the agreement. To the calculation of the lease term, it is important to remember to include any rent-free, if applicable, periods provided in the lease agreement. When we talk about no cancelable period, we talk about the period that the lease agreement cannot be cancelled by either party or cannot be cancelled without any significant cost, which is legally enforceable. Meaning that if the lease agreement is for 10 years and the parties have an option to cancel, to terminate the lease agreement after the completion of the second year of the agreement, then the lease term is not the 10 years for the standard, is the 2 years, which is a non-cancelable period. If the lease agreement is for 10 years and the parties involved in the agreement has the option to terminate, to cancel the agreement in a period of after the completion of 6 months in the agreement, then the period, the duration of the agreement is 6 months, not 10 years again. It's important to distinguish this when we determine the duration. Let's concentrate now on the options to extend or terminate. When we make this assessment to assess whether or not it's reasonably certain that either of the parties will exercise their options, we need to look at some characteristics, the contractual terms and conditions. The termination of the contract will be costly for the lessee or the lessor. This indication that will not exercise the termination option, will not be, the parties are not going to exercise the cancellation option, the termination option. Or what are the contractual terms about this? If the lessee carried out significant leasehold improvements, lease a property, make some leasehold improvements in the buildings, which is an indication that is expected to exercise this option. What are the costs relating to the termination of the lease and the importance of that underlying asset to the lessee's operation? If the asset is important to the lessee, then is expected to exercise the option or not exercise the termination option. We said that the duration of the agreement is important. It's important for two reasons, because the IFRS 16 is the option, not the requirement. We need to be careful. It's an optional exception. The leases that has a duration less than a year to treat them accounting wise as we did with the IAS 17. This is why it's important to consider the duration of the program. Any lease that has a duration of less than 1 year, we only recognize a lease expense of the P&L and nothing more. So, in this case, if a lease is a 10-year period and the cancel option is out 6 months, starts from the 6 months by the completion of the 6 months in the contract, then we talk about a short-term lease, and we have the option to just recognize a lease expense on the balance sheet, on the profit and loss, and not make any calculation on the balance sheet. It's an option. It's not, but don't have to apply this exception. The other exception has to do with the value of the asset. The value of for the leased asset that are of significant value, we only have the option to recognize a lease expense on the P&L and nothing more. The value, anything less than $500 of the underlying asset. How about a small note about the lease contract? We need to separate the components of the contract. We need to look at the lease agreement and distinguish between the lease items and the non-lease items. Like, for example, I am leasing a building, and at this lease agreement, on this lease payments are included the cost of maintenance, the building. These costs must be separated by the calculation that we'll demonstrate in a while. Here I have a case, the case of CleMo Ltd, in order to demonstrate how to identify the asset in a case. CleMo Ltd has 3 trucks under contract from Merit Limited. The trucks are each leased for a period of 5 years, during which time the CleMo Ltd can use them for any purpose and keeps them on its premises. They cannot be retrieved by Merit, except in the case of default of payments. The trucks are clearly mentioned in the lease agreement by their registration numbers. Both parties have the option to cancel the lease agreement after the completion of 2 years without the permission of the other party and with a marginal cost. No extension option exists. Merit Limited will supply a replacement truck if any of the 3 requires servicing or repair. The truck are returned to Merit after the 5 years. And we need to look at the characteristics of this case in order to identify whether in this case we have a lease agreement or not. Let's apply the steps. The first step, is there an identified asset? Yes, there is an identified asset. The trucks are clearly stated, explicitly stated to the lease agreement. And the Merit has the right to substitute the truck only for maintenance. If we go back to the case, we can see that it's only allowed to replace the trucks for maintenance only. Customer has the right to substantially all the economic benefits, as far as the CleMo has the right to use the asset without any intervention by the Merit Limited. Then we can say that has right to substantially all the economic benefits derived from using these trucks. Who directs how and for what purpose the asset is used? The trucks can be used at the discretion of CleMo Ltd. And another indication that answers this question is that the trucks are held at the CleMo's premises, which indicates a control over the asset. And what is the duration of the agreement? The term of the lease agreement is 2 years, because after the completion of the 2nd year, the contractual parties has the option to cancel the agreement at the marginal cost. So the duration of the lease agreement is only 2 years. Now, how to recognize, which is the last part of the definition provided for under the IFRS 16, the consideration, how to measure and recognize the consideration under a lease contract. The major impact that comes with the new standard has to do with the lessee accounting, because the lessor part of the accounting remains relatively unchanged. The lessee is the one that needs to apply a lot of new requirements. And the IFRS 16 states that at the commencement date of the lease, the lessee shall recognize a right of use asset with a corresponding lease liability. With this way, we correct the consistency of the previous standard. We recognize an asset because we have an asset, we control the asset, we generate some income from this asset. And the lease liability represents the financing method of the acquisition of these rights, which are the lease payable throughout the lease term. By recognizing this right to use asset in the balance sheet, the lessee is recognizing an intangible asset. Let's see how to make this calculation, measuring the lease liability. The lease liability is equal to the present value of the lease rentals. So if the lease agreement states that I have to pay an annual lease fee of 70,000 euros for the next 10 years, each year for the next 10 years, then these are my future lease payments. And I have to discount them back to today's value. The today's value is the commencement day of the lease agreement, plus any present value of expected payments at the end of the lease. The payments has to do mainly with the restoration cost of the leased asset, or any additional payments provided to the lease agreement. The question here is what discount rate to use to make these calculations. The standard said that you have two options of choosing the two main options of choosing the discount rate. The interest rate implicit in the lease agreement. You need to perform some specific calculation to identify the rate implicit in the agreement. Or if you don't have enough information to make this calculation, then you need to use the incremental borrowing rate. The incremental borrowing rate is calculated by making some assumptions. If you go to the bank, apply for a loan to acquire exactly the same asset as the leased asset, how much interest the bank will charge you? This rate must be used as a discount factors and discount rate to make this calculation. If not able to identify this, you can use your cost of capital. The lease payments are the sum of fixed payments that are provided to the lease agreement and any variable lease payments, which only for is a fluctuation of lease payments depending on a specific index, like for example inflation. The residual value guarantees, if applicable, is provided to the lease agreement at the amount lessee expects to pay. Any purchase option exercise price, if it is provided to the lease agreement, we need to identify the exercise price and discount it back to today's values. And then payments for terminating the agreement. Then, after the calculation of the lease liability, subsequently, we need to make some adjustments to this lease liability amount. The lease liability must subsequently measure by increasing the carrying amount of this liability to reflect the interest, which is the discount factor discussed before on the lease liability, reducing at the same time the carrying amount to reflect the lease payment, because we are making throughout the lease duration, we are making the payments, so we need to reflect this to this account. And if applicable, if necessary, remeasure the carrying amount to reflect any reassessment or lease modification, or to reflect revised in the substance fixed lease payments, if we have any lease modification later on, subsequently. Now, how to measure the right of use asset? We get the figure calculated before, the lease liability. We add up any initial direct cost, any cost incurred to modify the leased asset, to make it as we wish to operate it, any prepayments provided to the lease agreement, and any restoration or dismantle cost that has to do with the leased asset. And we deduct any incentives received, again provided to the lease agreement. Then subsequently, and this is how this new IFRS 16 is connected with the IAS 16 previously mentioned. Subsequently, we need to measure the right of use asset using three options. The cost model as described in IAS 16, the property, plant, equipment. We have the cost of the asset, we depreciate it over the lease term duration. Or the fair value model put forward by IAS 14, the investment property, if we consider the lease asset as an investment property, then it meets the requirements. The revaluation model as per the IAS 16 again provision to revalue the right to use asset constantly. I have the case of CleMo, the second case of CleMo. In order to demonstrate all this calculation, on January 1st, 2020, Merit Limited, lessor, enters into a 10-year building lease contract with CleMo Ltd, lessee. And we have this information, annual lease payments of 70,000 euros are made at the beginning of each year. We need to be careful of when the payments are made. If they are made at the beginning of the year or at the end of the year, because different calculation requires each option. In this case, we have the lease payment to be made at the beginning of each year. There is an upfront lease payment for year 2020 of 70,000. Mary Limited estimate that the building to have fair value of 700,000 euros, a carrying amount of 686,000 euros. The economic life of the building is 15 years, and the residual value of the building is estimated to be 200,000 euros. The initial direct cost is 20,000 euros, and the lease incentives are 5,000 euros. So we have all the necessary information now. How we can calculate the two figures that are going to be reported to our balance sheet. The first thing to do is to calculate the discount rate. If we have all this information, we can do this simple calculation, just plot in an Excel spreadsheet all the lease payments, the fair value of the underlying asset and the residual value, in order to, and we apply the formula of internal rate of return. We make all this calculation and we calculate the discount rate to be 4.7%. So the interest rate implicit in this lease agreement is 4.7%. And we are going to use this rate to discount back all our future lease payments. We are going to make in total 9 payments, one each of the next years, of 70,000. We discount the back using the implicit rate on the lease agreement of 4.70 of 4.7%. So, and we repeat line by line. So the sum of the present value of the future payments of the lease is calculated to be 504,262 euros. There is nothing complicated here. We just plot all the lease payment. We apply the present value formula using the discount rate of 4.7%, which is simple, 1 divided by 1 plus 4, 0.47 at the number of periods up to the next payment. Once we calculate the lease liability, we create the lease liability account. We credit the balances calculated at the commencement of the lease term, of the lease agreement, of 504,000 euros. And then we record each of the next years, we record each and every payment made for this lease agreement. We make this calculation, we charge this account with the interest implicit on this agreement. This represents the finance cost of obtaining the control of this leased asset, of the leased asset. Is of 4.7%. Due care must be provided given to this to revisit this interest rate and update them accordingly. Now, the right of use asset is 589,000 euros, is the lease liability of 504,000 euros, the initial direct cost, and the prepayment of 70,000. We deduct the incentive payments of 5,000 euros to calculate the right of use asset. And we have the right of use asset account. As with the other assets, we need to calculate depreciation. We get this amount calculated at the beginning of the lease agreement and divided by 10, which is the duration, the total duration of the lease agreement. And we depreciate over the life of the lease agreement. When we complete the lease agreement, the balance of this account will be 0. This will be charged on the P&L. At the initial recognition, we just doing this transaction, We recognize the asset by debiting our right of use asset, the no current assets on the balance sheet. Credit the lease liability, recognize the obligation for the lease payments, and we credit the bank or any payables, which has to do mainly with the initial direct cost and other costs incurred at the commencement of the lease agreement. As we said, to the lessor part of accounting, there's no significant changes. The lessor accounting remains similar to the current practice. The lessor needs to make his classification test to distinguish between finance lease and operating lease. And this unchanged part of the IFRS 16 lacks consistency with the new lease accounting model, and there's still a lot of work to be done by the board to correct this inconsistency. So, as we saw, all the requirements of IFRS 16 have significant impacts on accounting ratios of leases of the companies, especially all the companies that are expected to be mostly impacted are these operating in the retail industry and the airlines, which are using the leasing option a lot. With the introduction of the new standard, the IFRS 16, we have the correction of a significant inconsistency that has to do with the assets that are used by the business. Now the company's balance sheet will be more asset rich, but their liabilities will increase as well. The IFRS 16, over and above this simple calculation we demonstrated before, prescribe a number of disclosure in the notes of the financial statements, which are required in order to enhance the understanding of the users of the financial statements about the leasing activities of their company. And the new standard must be applied from the January 1st, 2019 onwards. That's all for me, guys. Sophie, back to you for question and answers.
Thank you very much, Marios, for that. I think very enlightening, I should say. Yes, we are going to go ahead now with some questions. The question and answer section is still open, so feel free to add your last questions. I think we'll have just enough time to get through our questions. Let's make a start with have disclosure requirements changed for lessees? Is our first question, Marios.
Yeah, there are a lot of requirements about the disclosure by the lessees. As we said, the lessees accounting is impacted by this new standard. The IFRS 16 requires a lot of new disclosure that has to do with the calculation of the discount rate, with the calculation of the right of use asset. At the notes of the financial statements, there's a requirement for a detailed analysis of this figure, how we calculate the right of use asset, how we calculate the lease liability, about the different types and categories of assets. Yeah. There is a significant amount of new disclosures that comes with a new standard.
Thank you very much for that. Let's quickly move on so we can try and cover our questions. A very quick one is, when did the lease standard change?
The new standard must be applied from the periods commencing from 1st of January 2019 onwards. There is a provision for retrospective application of the standard, given that it's practicable for the company to apply this retrospectively, and given that the company also applied the other new standard, the IFRS 15, the revenues from contracts with customers. And given that they apply this IFRS as well, they can apply the new standard retrospectively. But this is an option. There is a practical expedient provided by the standard about how to retrospectively apply the new standard. But as a general rule, the new standard must be applied from the January 2019 onwards. But we need to be careful on the comparatives to make the relevant adjustments to comparatives in order to maintain the comparability of our financial statements.
Thank you very much for that. So I guess people really do need to get themselves familiarized with these new standards. Our next question, it's a bit of a long one. I will try and get it outright for you. Due to IFRS 16, lessee is disclosing right of use of asset X amount, and lessor is disclosing property, plant and equipment X amount. How far IFRS 15 is justifying an asset is disclosed in the books of both lessor and lessee?
How far?
I think perhaps here we're saying so far the IFRS is justifying an asset, and I'm guessing that our participant would want to know with the new regulation what perhaps has changed.
About the disclosure of by the lessee.
This is my understanding. I will say, if it's not clear for us, Marios, we're very happy to get in touch with our participant after tomorrow morning and get clarification and come back with a more complete answer.
Okay.
If you prefer. Okay, so we will come back to that question directly to our participant who asked the question. I have another question. If the lessor provides lease vehicle with the driver, then control prevails with the lessee or the lessor?
The lessor provide the car, provide the driver as well, right? And who directs? The question here to be answered is who decides how to use use this asset and its driver. If the lessee controls the activities of this, how he or she is going to use this car, then we have a lease agreement. But if not, if the lessor controls, it's just go to the lessee's premises to pick up some items and transfer to another location, and this is it, and the car is driving back to the lessor's premises. This is not an indication of a control, so we talk about a service contract and not a leasing contract. Now, if the lessee controls how to use the car, then we have a lease agreement, and we need to be careful to distinguish, to separate the driver cost if it is included to the lease agreement and the lease cost that has to do exclusively with the leasing the car.
Thank you very much. So a couple of answers there, depending on the situation that our participant has in front of him. Thank you very much for that. Let's move on. What is the discount rate used to measure lease assets and liabilities if we cannot identify the lease implicit interest rate?
The discount rate, if we cannot be, okay, practically in real life, it is very, very difficult to calculate the interest rate implicit to a lease agreement because of the lack of information. Because we don't have information about the value of the fair value of the leased asset. We don't have any information about the residual value of the asset expected by the lessor. These are all informations at the hands of the lessor and is not always provided by the lessor to the lessee. So it's practically difficult to make this calculation. The other interest rate, the option that is provided by the IFRS 16 is that we can use the incremental borrowing rate of the lessee. What we mean by the incremental borrowing rate, the standard gives an example and says that if the lessee, instead of leasing the asset, goes to the bank and apply for a loan to acquire exactly the same identical asset as the leased asset, how much the interest the bank will charge for this loan? And then we are using this interest rate. If this scenario is not, again, not applicable, then it's difficult to calculate. Then we need to use the cost of capital of the lessee to make the calculation.
Thank you very much for that, Marios. I think our participants have lots of questions. Just to mention here, because some of you are actually asking some questions that perhaps require calculations, anything that does not get answered here today in the next few minutes, then we will come back to you with an answer to your question. But I will move on and see if we can fit in one or two perhaps. So next question for you, Marios. What will happen if the lease agreement is modified in terms of recognition, lease liability, and the right to use asset?
Yeah, the IFRS 16 provides guidance about this scenario, the modification of the lease agreement. Regarding the modification, we need to consider two things. If the modification is of such a nature that completely change the existing lease agreement, or if we just have some items modified in the existing agreement, which is the continuation of the existing agreement. If we talk about a new lease agreement, the two scenarios requires different accounting treatments. If we are talking about a new lease agreement, which means that the modification changed the scope of the lease agreement. The scope of the lease agreement is changed if we have changed in the duration of the lease agreement or to the lease payments of the lease agreements. If these two modifications are made to the lease agreement, then we talk about the new lease agreement, and we need to apply the relevant accounting. If the modification has to do with just we add the option of purchasing the lease asset at the end of the lease agreement, or we add an option to terminate or extend the lease agreement. Then we have a modification of the lease agreement and a continuation of the existing agreement, and not we don't have a new lease agreement. And we make adjustments on the rate. We're making the calculation, and because we have the addition of the option to purchase the asset of the lessor at the end of the lease agreement, or we reflect these changes to our existing calculations. If the modification has to do with the change in the scope of the lease agreement, then we need to redo all this calculation as per the provision of the new agreement.
Thank you. I think we'll have time for just a very fast one. I'm trying to choose one that I think will not require too much. And as I said before, we will come back to the other ones and send you individually a reply to your question. Also, many of you are asking with regards to the presentation and the recording. We will send those to you as well sometime tomorrow. So anything that you missed or to recap, you'll be able to do that. So Mario's last question for you today. Will licenses to use an asset come under IFRS 16?
Licenses to use the asset, again, we need to look at the control. A lot of emphasis is put on from this IFRS 16 on the control, where control how to use this licensed asset. Then we talk about the lease agreement. If not, then we need to apply other accounting standards. Again, we need to look at the control of the asset, at the specifics of the agreement.
Thank you very much. I think on that note, I'd like to say a big thank you to everybody who joined us today. I hope you all took away some insight from Marios. He's already on the screen added his own email anyway, so you can contact him directly if you need to. But any questions for sure that were raised here, we will come back to you, and you will have both my own and Marios' details should you need any further information on that. And we will keep you posted. As I said at the beginning, we hope to be able to come back to you with a few more webinars in the following months. So thank you for joining us, and have a lovely evening.
Thank you, guys.
Bye-bye.
Bye-bye.